Today, we're going to explore the concept of discounted cash flow analysis, or DCF, as it applies to real estate. Essentially, DCF is a method that helps us estimate what a property is worth right now by looking at the income it could generate in the future, then adjusting that value back to today's dollars. It's a practical and clear way to see the potential value of an investment property based on its expected cash flows. Over the next 14 slides, I'll guide you through this process step by step, making what can sometimes feel complex into something much simpler and more understandable. Here, we're looking at the concept of income first, followed by hype. The core idea is that the discounted cash flow, or DCF, method takes expected rent, expenses, and the resale value of property and turns all of that into a single present day estimate of value. The big idea behind DCF is pretty straightforward. It asks, what is this property's future income worth today? This approach is crucial because it helps investors look beyond just the asking price or market excitement and instead focus on the actual earning power of property. Understanding this helps make smarter, more informed investment decisions. The core principle behind the discounted cash flow, or DCF, method is the time value of money. Simply put, a dollar today is worth more than a dollar tomorrow. Why is that? Because money you have right now can be invested to earn returns, and it comes with less uncertainty compared to cash you expect to receive in the future. So, cash in hand today holds more value, while cash received later is worth less. The DCF method accounts for this difference by adjusting future cash flows back to their present value, giving us a more accurate assessment of worth. Here we're diving into the heart of the discounted cash flow, or DCF, formula. The main idea is to add up each of the future cash flows, but not just as they are. We adjust them to account for both the time value of money and the risk involved. Why? Because a dollar you expect to receive in the future isn't worth the same as a dollar today. At the core, the DCF formula looks like this. You take each expected cash flow, which we call CF for cash flow, and divide it by 1 plus the discount rate, raised to the power of the year number. So, CF is divided by 1 plus R to the first power, CF2 by 1 plus R squared, and so on. And at the end, we add the terminal value, or TV, which is essentially what you expect to get when you sell or exit the investment. The discount rate, noted as R, represents the risk and opportunity cost of the investment, while N is simply the year number for each cash flow. This approach allows us to express all future dollars in terms of today's dollars, giving us a clear, present value estimate of the asset or investment. When we talk about projecting future cash flows, the first step is to forecast the property's yearly money coming in and going out. This includes rental income, which is the main source of revenue. Then we consider vacancy loss, which accounts for times when the property isn't rented out. We also factor in other income, such as fees or additional services the property might offer. On the expense side, we look at operating expenses, things like maintenance, management, utilities, and insurance. Capital reserves are also important. These are funds set aside for major repairs or improvements down the line. The goal here is to estimate the net operating income, or NOI, which reflects the annual cash flow the property can realistically generate. Typically, we forecast these cash flows over a period of 5 to 10 years to get a clear picture of property's financial performance over time. This helps in making informed investment decisions. The discount rate represents the return required to compensate for risk. In real estate, it usually reflects the investor's expected rate of return or the overall cost of capital used to convert future cash flows into their value today. Several factors influence this rate. First, property risk includes aspects like lease stability, the quality of tenants, and the condition of the asset itself. Next, market conditions play a big role, including interest rates, cap rate trends, and local demand for properties. The type of asset matters too. Office buildings, multifamily units, retail spaces, and industrial properties all carry different risk levels. Then, capital structure comes into play, which involves the cost of debt and the return equity investors expect. Generally, a higher risk leads to a higher discount rate. Essentially, the discount rate is the return investors expect for taking on the risk and waiting to receive future payments. It's like the price you pay for the uncertainty and the time value of money. Now, let's dive into step 3, calculating the terminal value. This is essentially the what happens after year 10 part of the valuation. It's really important because it captures all the cash flows beyond the forecast period and often represents a majority of a property's discounted cash flow value, usually more than half of the total value. Why does this matter? Well, real estate assets continue to generate income well beyond the initial hold period we've modeled. So, the value in those tail years can actually outweigh the value from the first few projected years. There are two common ways to estimate terminal value. The first is perpetual growth method, where we assume that the net operating income or cash flow grows at a stable, long-term rate indefinitely. The second is using the exit cap rate, where we estimate a resale value by capitalizing next year's NOI using a market capitalization rate. The key takeaway here is that even small changes in either the growth rate or the exit cap rate assumptions can significantly impact the overall valuation. So, it's critical to carefully consider these inputs when calculating terminal value. Now, let's talk about discounting back to present value, which is a final step in the discounted cash flow process. Essentially, each future cash flow is worth less today because of time and risk factors. So DCF translates those future amounts into today's dollars. The key formula here is present value equals cash flow divided by 1 plus the discount rate raised to the power of the number of periods. When the discount rate is higher, it reduces the present value, meaning future cash flows are considered less valuable today. Also, cash flows that occur further in the future are discounted more heavily since there's more uncertainty and a longer wait. By adding up each discounted year, we get an estimate of how much the entire stream of future income is worth right now. This matters because time and risk both diminish the value of future income. Understanding this helps investors make better decisions about what an investment is truly worth today. Here's a quick example to bring the DCF model to life. Imagine a 12-unit apartment building in a stable urban area. We're looking at purchasing it for $4.8 million. The net operating income, or NOI, is expected to grow steadily at about 3% per year. We project the annual cash flow starting with $280,000 in year one, gradually increasing each year up to $306,000 by year 4. The exit capitalization rate, which helps us estimate the property's value at sale, is 5.5%, applying a discount rate of 8% to these forecasted cash flows and the terminal value. We calculate the present value of this investment at about $5.1 million today. The key takeaway here is that the DCF isn't just about numbers on a page. It's about visualizing the real property behind those numbers. This model helps us move beyond guesswork to a tangible, data-driven valuation. When we look at key assumptions in a discounted cash flow model, it's important to remember that the model's output is only as reliable as the inputs we provide. Small changes can cause big swings in valuation because every assumption compounds over the years and then feeds into the terminal value. Starting with income, the revenue growth rate plays a crucial role. If rent or occupancy grows faster, it lifts future cash flows and increases the overall value. Simply put, more growth means higher value. On the other hand, costs are just as important. Expense inflation can squeeze net operating income over time, reducing the present value. So, when costs rise faster, it hurts the valuation. Another critical factor is the exit cap rate. A higher exit cap rate lowers the terminal value. And because this terminal value often makes up a large portion of the total valuation, changes here can have a huge impact. Finally, the discount rate reflects risk. A higher required return means future cash flows are discounted more heavily, which lowers present value. So, higher risk equals lower value today. All these assumptions interact, and understanding how each moves the model helps us interpret results with confidence. When we talk about sensitivity analysis, we're really looking at how changes in our assumptions impact the valuation. Discounted cash flow, or DCF models, are particularly sensitive. Small tweaks in growth rates or the discount rate can cause significant swings in value. For example, if we adjust rent growth or the annual NOI growth rates up or down, or if we shift the required return, the estimated property value changes noticeably. We outline 3 scenarios here to capture a range of possible outcomes. In the optimistic scenario, we assume higher growth and lower risk. leading to a value increase at about 17% above the base case. The base case represents the most likely outlook with moderate growth and risk assumptions. Then there's a pessimistic scenario, which assumes slower growth and higher risk, causing the value to drop around 15% below the base. The key takeaway is that instead of relying on a single valuation number, best practice is to model a range of scenarios. This approach gives a fuller picture of potential outcomes and helps make more informed decisions under uncertainty. When using a discounted cash flow analysis, it's crucial to be aware of common pitfalls that can lead to misleading results. First, remember that the DCF is only as reliable as the assumptions behind it. Overly optimistic projections, like inflated rent growth or occupancy rates, can make a weak investment appear much stronger than it really is. Similarly, using unrealistic discount rates, especially rates that are too low, tend to overstate value and downplay the level of risk involved. Another important factor is market cycles. Real estate values fluctuate, so assuming things will remain flat ignores these natural ups and downs and can lead to inaccurate conclusions. Terminal value estimates are also a common stumbling block. Small errors in the exit cap rate can dramatically alter the final valuation. Ultimately, what matters most is pressure testing these assumptions thoughtfully rather than just relying on the numbers the spreadsheet spits out. Always apply a sanity check to your model to ensure the story behind the data makes sense, rather than falling into the trap of blind spreadsheet confidence. Here we compare the discounted cash flow method, or DCF, with other common valuation approaches. The key idea is that all these methods aim to determine value, but they look at it through different lenses. DCF really shines when the future matters. For example, with properties undergoing lease-up, redevelopment, or uneven growth over multiple years. It's forward-looking, capturing timing, growth, and exit assumptions in detail. On the other hand, market-based methods like comparables or comps provide a snapshot based on similar recent sales, making them useful when there's strong and relevant sale data available. Meanwhile, the income approach calculates value based on current income and a capitalization rate, which works best for stabilized assets with predictable cash flows. Each method has its strengths and trade-offs. DCF is powerful but sensitive to assumptions and requires a well-thought-out story about the property's future. Comps can give a quick market reality check, but struggle when comparable sales are scarce. The income approach is simple and intuitive, but might miss gradual changes over time. Overall, DCF is most useful when property story unfolds over several years and future cash flows truly drive value. To wrap up, let's focus on some practical takeaways for using discounted cash flow analysis effectively. First, always base your model on real operating assumptions. This means accurately projecting rent, expenses, and the potential exit value based on actual market and property data. Next, use a discount rate that truly reflects the specific risk of the property and the current market conditions, rather than just defaulting to a generic figure. It's also crucial to stress test your assumptions. Look closely at growth rates, vacancy levels, capitalization rates, and holding periods to understand how sensitive your valuation is to changes in these factors. Remember, DCF is a decision-making tool. It's not about finding a single exact number, but about testing and validating the story behind your numbers. Ultimately, confidence in your underwriting comes from being grounded in thorough analysis and tangible data, not guesswork. This approach will help you make smarter, more informed investment decisions.